If the bull market of the 70s drove gold up 25 times and silver up 41 times, with only 1/25th the amount of currency per ounce chasing them, and then you add fear to the mix, just what do you think will happen this time around? Ounce of gold and silver you own today, you are going to be able to buy many, many times more stocks, bonds, real estate, businesses, and just about anything else you want or need. One day, the precious metals are going to amaze everyone. Make sure you come back and read this chapter once gold goes soaring past $3,000, $5,000, $10,000 per ounce and never looks back, because the great gold and silver rush of the 21st century is absolutely going to take your breath away.
Gold's price surge to over $3,400 has lifted it to all-time highs, which may signal that speculators have become overly bullish and complacent. The risk that gold bugs have become too optimistic isn't lost on Citigroup, whose commodities analysts released a new gold price outlook this week. The analysts' latest take on gold is anything but glittering. Market specialist Mike Maloney states gold's setup is strong and predicts it could surge past $10,000, emphasizing that value is everything. In his assessment, Maloney believes April 2024 marked the beginning of the third and final phase of the bull market, much like the 1970s. The 1970 bull market saw gold rise an incredible 2,382% from $35.40 to the top at $878.50. The 2000s bull market rose only 662% from the bottom at $252.10 to the top at $1,923. If the current bull market was to equal the gains of the 1970s bull market, then gold would need to top out at around $6,000. However, appearance is more important than equaling the magnitude of the rise. While reflecting on historical evidence, Maloney recalls the 1980 gold surge, when prices jumped 34% in 5 days, triggering mass panic buying. Driven by crises in Iran and Afghanistan, people fled paper currencies for gold valued, as Alan Greenspan noted, for being beyond government control. While commodities typically rally during periods of robust economic growth, the current upswing is primarily driven by geopolitical risks and increased investment demand for tangible, hard assets, particularly precious metals. Looking at fundamentals, Maloney predicts that the next gold and silver rush will dwarf the 1980s, driven by far more capital, a larger number of people, and a limited gold supply. With 50 times more money but only twice the gold, he foresees a significant price surge. Before we dive into Mike Maloney's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.
Remember, I have been waiting for this bull market for 20 years. I started investing in gold back in 2002. I became a precious metals dealer in 2005. I released the best-selling book on the subject in history in 2008. I released the current best-selling book on the subject in 2023. So I've been waiting a long time for this, and the evidence is there. What we have to do is take a little trip down memory lane and look at where we are in this bull market compared to the last time gold and silver were in a bull market back in the 70s. And so we're going to be looking at media attention here. So gold and silver have been making some headlines. Gold was on the cover of Barron's in April. So this April, sort of to me, marks the turning point from the end of the second phase of the bull market into the third phase. And then, so covers of magazines, front page on newspapers, Financial Times with gold. Even the Wall Street Journal is now telling people how to invest in gold. That many Wall Street professionals now recommend having at least a small portion of gold in your portfolio, even though it has been the #1 performing asset class of this century. Stampede for Precious Metals, Time Magazine, January 28, 1980. Last week, gold left even its most frenzied boosters gawking in astonishment. In 5 wild and erratic trading days, it leapt by an incredible 34%. It was one of the most dazzling run-ups in history, and it underscored the enduring psychological lure of the yellow metal as the most consistently sought-after possession in times of strife and uncertainty. Harvard social psychologist Roger Brown compared the panic to the rush on the gates of the Who concert in Cincinnati that left 11 dead. Says he, the fear that they are going to be too late and left out causes people to stampede. In cities throughout the U.S. and Europe, people by the thousands lined up at jewelry and coin shops lured by newspaper headlines of eye-popping new prices for gold and silver, and even by hourly news broadcasts on the radio. Of course, the rise reflects intensifying anxiety over the world situation, particularly the crises in Afghanistan and Iran. In times of such great concern, people are moved to switch out of paper currencies and into objects that seem immune to political travail. Observes Alan Greenspan, gold is a store of value that governments cannot seize, devalue, or easily confiscate. Still, the U.S. eventually may pay a high price if bullion keeps leaping. If a dollar is only worth 1/800th of an ounce of gold, then it seems to be worth almost nothing. I remember this fairly well. I remember watching the local news broadcast and being amazed at the helicopter shots of the line of people waiting to get into a local coin dealer. This dealer was only a few miles from my home, located on a major city street in the center of the block, with sidewalks about 15 feet wide, and the line of people went out the front door, stretched down the block, filling the sidewalk, around the corner, and up the side street. The news media were interviewing people in line, and the lines were being compared to those for Star Wars and Apocalypse Now. Now we really get to, so that's how the media reflects what's happening today. Is just the beginning of the media waking up and noticing this, and that's what starts the stampede. Adding it all up. So now let's add it all up and try to estimate just how much currency could come chasing gold and silver in the great gold and silver rush of the 21st century. Versus 1980, today we have 18 times more people around the world that can buy precious metals, 55 times more currency, 56 times more millionaires, 200 times more billionaires, 220 times more available consumer credit, 31.5 times more assets under management, and 49 times greater global stock market capitalization. It's actually impossible to add all of this up. It really doesn't matter if there's 18 times more people who can buy gold and silver. What matters is how many people will buy gold and silver. It really doesn't matter that there's 55 times more currency in the world. What matters is that almost all of the newly created currency went to people who were already well off, people who have significant assets to protect and therefore have an investor's mindset. These are the people who will seek the safety of gold and silver in the next crisis, driving their prices to unimaginable heights. Now, as I said before, I don't want to double count anything or anyone here. So, to make this easy, I'm just going to lump currency, credit, assets under management, millionaires, billionaires, people with an investor's mindset, and the people with significant assets to protect all together and just pick a number the best I can. Let's say there's probably 50 times more currency available today for investment in gold than in 1980. Yet the amount of available gold in the world has only about doubled, so that's 25 times more currency per ounce. Then to that 25 times more currency per ounce, we must add the speed of light news and market dynamics, and that gold and silver are giffen goods that create more demand as the price rises, and the fact that their price responds positively to war, geopolitical crisis, economic crisis, and just about anything else that causes human anxiety, and you can still only get a tiny little inkling of just how big this thing is going to be.
In the interview, Mike Maloney mentions his book, The Great Gold and Silver Rush of the 21st Century, and introduces gold and silver as giffen goods. Unlike typical goods, demand for gold and silver surges when prices rise, driven by fear and greed. Concurrently, Maloney displays emotion-driven charts, noting gold spikes in response to fear while stocks crash. He recalls gold's 1979 and 1980 surge from $428 to $873 in just 29 days due to panic over the dollar. Precious metals have been on a tear this year, with gold, silver, and platinum all posting returns above 20%, making them an alternative asset class that has long been an investor's safe haven during times of market volatility. Not only are central banks expected to continue buying gold over the next 12 months, but the precious metal is also attracting significantly more attention from the official sector than at any other time in the past decade, according to the latest survey from the World Gold Council. Drawing from vintage media like Time magazine, Maloney reveals how institutions once scrambled for gold. He predicts an even bigger rush, fueled by global fiat distrust and rising fear. Let's get back to the interview.
from my book, The Great Gold and Silver Rush of the 21st Century. And we're going to start with Chapter 7, Enormity Squared. I'm going to read you the last 7, and in those last 7 pages, you're going to get a glimpse of why this thing is going to be so big. This will give you just a little inkling of where things could possibly go in this explosion that lies ahead. The laws of supply and demand are fairly simple. As the price of a good rises, demand will fall simply because people can't afford as much of it, so they will seek an alternative item that is cheaper. Conversely, when the price of something falls, people will buy more of it because basically it's on sale. But in 1890, the Scottish economist Sir Robert Giffen proposed that there exist certain special types of goods that exhibit properties that violate the laws of supply and demand. Giffen theorized that these items always create more demand as their price rises. There is still a debate among economists as to whether Giffen goods actually exist, but I'm going to put a stake in the ground right now and say that gold and silver are the ultimate Giffen goods. Gold and silver sometimes exhibit supply-demand properties that are the exact opposite of other goods. When the price falls, nobody wants them. But when their prices rise, everybody wants them. They also exhibit fear and greed dynamics that are the exact opposite of the stock markets and simultaneously exactly the same. I know this sounds weird, but hear me out. If the price rises a little, some people see other people making gains, and they want in on the action too. This is the greed-driven portion of the price rise, and emotional dynamics are still the same as the stock market. But if the price rises beyond a certain point, some people will still be buying out of greed, while a few people start to get worried about the economy and they buy because of fear. This is the portion of the price rise where the polar opposite emotions of greed and fear exist simultaneously. It is also the portion where gold and silver begin to exhibit Giffen good properties. If the price continues to rise, or if there's a stock market crash or a problem in the economy or the currency, then a fear-driven panic can take over, causing more people to buy, which causes the price to rise more. This is the point where all of the sellers, the people who would normally sell and take profits because of the high prices, completely vanish from the market. They hold on to their gold more tightly because of their own fear, causing supply shortages, which causes many more people to panic, so they buy a lot more, causing the price to skyrocket, and so on and so on. The shape of fear. Now, this is important also. Now I'm going to present you with a couple of charts, but I don't want you to read them like you would read a normal chart. In fact, I'm not going to put dates, numbers, or scales on these charts. Instead, I want you to look at the shape of these charts and try to see the emotion in them. What is the emotion in these pictures? Yes, charts don't always have to be cold, analytical things. Many times, they convey the visceral emotions of greed and fear. This is a chart of one of the most popular stock market indexes. Notice that it has smooth, rounded tops, but when the markets are crashing, fear takes over, and the chart makes these sharp V-bounce bottoms. The run-ups and rounded tops are a picture of greed, whereas the sudden crash and the V-bounce bottom that looks like a spike, a nail, or a knife is a picture of fear and panic. Here's another chart. Do you see the similarities? The same rounded tops and the spiky, fear-driven bottoms? The first chart was the S&P 500 index adjusted for inflation, but the second chart is not a chart of the stock market, it's a chart of gold. The reason it doesn't look like a chart of gold is because I've inverted it. I flipped it upside down. Here's the same chart of gold viewed right side up. That big fear-driven spike that starts on December 3rd, 1979, when gold surpassed its all-time high of $426 per ounce set the previous October, hitting $428 an ounce. That was the day gold took on the characteristics of a Giffen good. Although some people were feeling greed and just chasing the price, you must remember that the US dollar had only been a fiat currency for a little more than 8 years, and many people were concerned that the US dollar could actually fail. Their fear and panic caused gold to soar from $428 on December 3rd to more than $873 per ounce over the next 29 trading days, peaking on January 21st, 1980. To give you an idea of the emotion and psychology that was driving the gold price in 1979-1980, I've included an excerpt from an early draft of my first book. So what I'm going to read you next, I wrote probably in 2006, and then 50% or 70% of it was edited out of my first book. So this is basically the original draft. Gold had started rising from $35 an ounce almost immediately after leaving the dollar. But in 1971, anyone who said gold could reach $50 an ounce was considered crazy, and anyone who said that $100 per ounce was possible was tied up, hauled away, and placed in a rubber room. But in late 1978, gold broke through the $200 barrier, and something changed in the character of how gold was being traded and how gold was viewed by the public. Gold was once again acting like money. In God We Trust, Time Magazine, June 11th, 1979. In the past 2 years, a new brand of buyer has flocked to the market, American institutional investors. Some U.S. pension funds, mutual funds, and bank trust departments are putting a portion of their assets into bullion. In 1979, people started lining up in front of coin shops, and the phones were ringing off the hook at the commodities exchanges. The Glitter That Is Gold, Time Magazine, October 1st, 1979. From Zurich to Chicago, from London to Hong Kong, gold bugs are scurrying once again to buy into their favorite hedge against disaster. With people battered by inflation and recession, worried about oil, and lacking confidence in leaders and cures, the gold rush of '79 has turned into a stampede.
From gold's behavior as a Giffen good to Mike Maloney's bold prediction of $10,000 per ounce, today's setup dwarfs previous bull markets. If gold truly reflects the world's anxiety and trust in the currency, are we now witnessing the early stages of the biggest monetary wake-up call in modern history? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.